So, this is an unusual one. This is an Insta Live. We're not going to interact with people. What this one is that there was a load of people at the Enough seminar a couple of weeks ago. And what we did was we took questions and I didn't get through all the questions. Actually, give everyone a minute just to join in and then I'll start explaining what I'm doing here tonight. Okay, so what I'm going to explain is, but the purpose of tonight is a little bit different than an ordinary Insta Live where I get you guys on and engage with you. This is about questions that were asked at the end of the Enough seminar that I delivered a couple of weeks ago. And people's questions, we didn't get to answer all the questions. We literally got hundreds of questions. And we answered as many as we could, and we couldn't get through them all. So this was just, we were going to do a video and just send it to people in the seminar. And then I said, why not just do it live and we can send them the video of the live. So some of you will have been at the Enough seminar, some of you won't, but I'm sure you'll all get benefit from it. So what we're going to do is I actually have the questions here and I'm going to go through each of them and get through as many as we can, but we're going to keep this to kind of 20-30 minutes maximum. Before we start, I'm not sure if people heard today, but How to Be Good with Money Series 4 is coming back. So I'll start filming in the next couple of weeks, I'd say, and it'll be back on screens again in January. So that's great news. We were waiting for that. That's why I shaved. But also we will be looking for people to participate in the show. We call you guys contributors. So we'll be looking for contributors. I don't have details. We're not set up. It's literally just hot off the press that we're getting the show. So it'll probably be early next week. Watch out for details. I'll post them up here and on other social media about how you apply to be on the show. So let's jump into this. I'm going to read the questions. The questions are beside me, so sorry I'm not looking at you. We have 3 small children, all under 8 years of age, one of whom has special needs, Down syndrome. Like all parents of kids with special needs, we are nervous of what will happen to our son and how he will be looked after if anything should happen to us. We have set up a discretionary trust for him in our will, but are unsure what the best way to fund this is. We're currently being heavily pushed by an insurance broker to purchase a whole of life insurance policy to fund the trust. Okay, this is quite a detailed question. There's a lot more to it, but really I think we need to break it up a little bit. So this person is a child with Down syndrome and they're worried about what would happen to that child if they passed away. And they have set up a discretionary trust. Now, it's an interesting one because there's lots of different types of trust there. And what I would say is a discretionary trust, and I'm not a solicitor, first of all, just to say that I'm not legal, I'm a financial planner. But my understanding of discretionary trust is you basically appoint someone you trust, the trustee, that you are going to give them money or give them the assets that the trust holds for the benefit of another person, i.e. in this case, your child. So what happens is when you die or when the trust kicks in, the money gets passed to the trustee, the person that you trust, and they look after it and they use it for the benefit of your child. In this case, your child, whoever the beneficiary is. And it's usually because the person, the beneficiary, isn't capable of making the decisions for themselves financially. And that might be on lots of different scales in terms of the spectrum of their capability to make the decisions, but it's just that the parents in this case feel that the trust makes sense. There are some advantages to it. The money is for the benefit for the child in this case, but it's not actually owned by the child. So that means when it comes to means testing social welfare benefits, it's not taken into account provided the trust is set up properly. The other thing is sometimes people say, oh yeah, but I trust the person now, but will I trust them in the future? What does that mean? Like, how is that going to work? If they go, there's lots of rules and legislation, and the trustee has what's called a fiduciary responsibility, and the fiduciary responsibility is that they must act in the best interest of the child, and there's legal things to protect there to make sure that the child or the beneficiary, doesn't have to be a child, that the money is used for them. So this person's concern is that they're saying, well, what am I going to do? How do I fund the trust? To me, funding the trust is about trying to get the money into the, if you've got spare surplus cash, that you use it for the benefit of the children. When you read down through further into this, these people, their mortgage is gone in 2 years' time and they're paying €1,000 a month off the mortgage. So they are going to have free assets there to be able to drive into this trust. I really think, like, the other question that they've asked is, what happens if there's an insurance broker or a broker trying to get them to take out €150,000 death benefit for €100 a month? To me, that particular policy you're talking about seems to be more like something like a Section 72, because there's 50,000 payout at the end of it. Or maybe it's a whole of life. There's not enough information there to know. But really what you need to do is you need to consider that the money that the trust owns, the money that's invested or put into the trust, is for the benefit for the children. If it's a long-term thing, if you're not planning, like you're only young, you're 44 years old, I would be thinking, long-term investment, really get advice. Look, I don't want to diss the broker, but just the way you're speaking about them, it doesn't seem like that relationship is working. So I think you need to get a solicitor that you have a relationship with that really works well. I think you need to get an advisor or a broker that you're really, really happy with. And ideally, you want to get someone who will work together, both the solicitor and the broker. Be careful though, because there's lots of things out there that look like trusts or are called trusts, but they're not actually the discretionary trust that I've described there. And discretionary trusts, you shouldn't be taking advice from me on them. You should be talking to a solicitor about that. They're the ones who are going to be able to set up this the trust properly. So let's move on to another question. I hope that gave you some insight. Can you clarify what the 35% set charges monthly include? My understanding is mortgage, car loan, personal loan, doesn't include utility bills or anything else. So this is where I always talk about the 35% rule. What does the 35% rule mean? Basically what it means is that you shouldn't have financial commitments. And I'm talking about like loan commitments, car loans, anything like that are greater than 35% of your take-home pay. So your car loan, your mortgage, your rent. If they go above 35%, what you generally find is you can't maintain that long term. Like there are people, particularly in Dublin, Cork, Galway, the big cities where the rent is so difficult at the moment that they're paying 50, 55%. What I inevitably see there happening is over time when you've broken the 35% rule, you will start to accumulate credit card debt, you'll start to add debt to your debt, and you're on that spiral very, very quickly because it's really hard to live your life on less than 65% to cover everything from utility bills and everything else. Clients of mine who would have less than 15% of their salary going out on financial commitments like loans and mortgages and that type of thing, they're the ones who really create wealth because you can sustain 35%. So if you've only got 15% going out, you have about 20% of your take home pay there that's surplus and you can still live a decent life beyond that. So just be careful about how much you put towards that. Next one. My main concern is planning for college for my two children, 15 and 13. How much is advisable to save and into what type of scheme? We have pensions, but what would Owen advise to look at to make sure they are working for our family's needs? Is there a recommended percentage of income to spend on bills, to save on necessities, for social and hobbies, to have a buffer for contingency? Okay, there's lots of questions in there. The first thing I'd say to you is you have two children and you've got an interesting spectrum on them. One is 15 years of age and one is 13. Let's assume both of the kids are going to go to college at 18 years of age. The 15-year-old only has a 3-year time horizon. So that means it's a short-term goal. You need to use a short-term vehicle there. You could get very technical and say you need a short-term vehicle for the first 1 or 2 years in college and the last 2 years are beyond 5 years from now. You could get very clever about saving in a long-term vehicle for that. But just try and apply the rule. Where the goal is less than 5 years from now, you use a short-term vehicle. It's a short-term goal. Where the goal is more than 5 years from now, it's a long-term goal and you use a long-term vehicle. The big mistake that people make is when they look at a long-term goal, like putting a child through college and you're thinking about a child who's 1 or 2 or 3, when it's more than 5 years away, they still, it's a long-term goal, but they still use a short-term vehicle like an on-post account or a bank account or a credit union or something like that. This person is right in slap bang in the middle. The 15-year-old should really be using a short-term vehicle. The 13-year-old should be using a long-term vehicle. The amount of money you need to put in is, have you got anything already? Would be the first question. If you've got money already, well then you might have to put less in on a month-to-month basis. The Union Students of Ireland tell us, they're not kids at that stage, that when a child goes to college, it'll cost you about €12,500 to €12,500 a year. If they live away from home, and about €7,500 a year if they live at home. Now, some people will say that's nowhere near enough, I'm forking out much more, but I've also met people who say that they pay out significantly less than that. That's what an average is. An average is, because some people are up here, some people are down here, and the average is the bit of when you add them all up and divide them by the number, that's what it is. So 12,500 versus kind of 7,500 is what you're looking at per year. So if you take the 12,500 number, that's 50 grand over 4 years in college. Now, if you put €140 a month, which is the current child benefit, if you put €140 a month away every single month for the next 18 years, and you manage to get 1%, 1% would be very high on a bank account on a short-term vehicle. But if you manage to get 1%, you'd have about 33 grand. Remember, you need 50. You'd have about 33 grand in it when they turned 18. Full 18 years at 140 a month. If you manage to put it into a long-term vehicle, like you should, like a 60-40 no-brainer portfolio, you'd end up with around 33,000 if you manage to achieve 4%. Now, last September, I was doing a piece, I think it was with Claire Byrne, nearly sure it was Claire Byrne, but I was doing a piece when people were going back to college, and I looked at some of the funds that were available 18 years ago. And I worked out at €140 a month, how much would they actually be worth if they had have invested in that fund? €66,000 is what they would have come out at. So you've got a choice. You can use a short-term vehicle and maybe get an average of 1%, and you're at 33 grand. Or you can use a long-term vehicle like a 60-40 no-brainer portfolio, and that one is around 44 grand if you get 4% per annum, which is a very conservative, reasonable expectation for that over that period of time. Or if you look at history, and I didn't handpick that, I didn't cherry pick that fund just to try and get a decent number. That was a fund that's very popular, that's been around for 18 years in the Irish market. Lots of people are invested in it. And before anyone asks, I'm not going to tell you who it is. I'm not giving that company a plug. I'm not giving that fund a plug. And it might be right for you and awful for somebody else. So what I would say is that 66 grand was the amount of money that you would have got out over the last 18 years. So just use the money wisely, do it correctly, and make sure that you're not making life much harder for yourself. I'm in my mid-50s and I work in the HSE. I need to buy back years as my pension contributions were interrupted. However, I have 8 years of NHS pension, which start paying out when I'm 60. Nobody was able to answer if I should roll this into my HSE pension due to uncertainty due to Brexit. I am now able to work until age 70 and currently I'm happy and willing to do this as I enjoy my job. Any idea what buying back these years cost? Also, advice on the NHS pension that starts at 60. I don't need it at the moment, so should I reinvest it? I'm not surprised nobody's giving you advice. The problem here is we don't have the information. First of all, what you need to do, the easy question to answer is how much is it going to cost me to buy back years? You need to just go to the HSE and say, how much will it cost me to buy back the years? It'll take them a long time to give you the answer. So in the meantime, there is a website. It's a HSE website, and you can pump in, if you can calculate that buyback years, I'm not 100% sure, but there's certainly a HSE website, I've posted it before, that will tell you how much your pension entitlement's going to be. There's too many unknowns in that question. I'm really sorry, but the unknowns are like, you've 8 years in NHS, but what was your salary then? You're 60 years of age. Would you be able to roll it into the NHS over the HSE? That depends on when you join the it depends on so many things. So kind of I'm dodging a bullet here in terms of a real politician's answer, but I kind of don't have enough information there to be able to give you the answer. I have read that if you have to make up pension years, you should take half your age and save that percentage of your salary in your pension. What do you think of that? Half your age. So you read that if you're trying to make back years, if you start pension at 30 and you should have started paying into pension at 20, you take half of your age and save that as a percentage of your salary. Wow. Yeah, I'm going to be honest with you. I think that these little calculations are actually deadly. I really like them. I think they're brilliant because they give you something to think about. Let's just make this much more simple, though. Half your age, but wow. Let's make this much more simple. Let's just assume that when you're in your 20s, you're allowed to put 15% of your salary into your pension. When you're in your 30s, you're allowed to put 20%. When you're in your 40s, 25%, 50 to 55, 30%, 55 to 60, 35%, and then over 60, 40%. That's how much you're allowed to put into pension. How much you should be putting into your pension? As close to those maximums as you possibly can. It's as simple as that. You should be putting as much into your pension as you can possibly afford to not to have access to until you retire. Those calculations are lovely. I really like them, but you're getting too complicated. Just put in as much as you can. It's a great thing. We are the envy of people worldwide when it comes to what our pensions look like and how our pension structure works. If I was to tell you, walk into the bookies next Saturday morning, bookies are open again, I noticed that today, but if you walk into the bookies next Saturday morning and you put €6 down and they're going to hand you back €10 immediately, you do it hand over fist every single time. That's what you get as a higher rate taxpayer with a pension. €8 turns into 10 if you're the standard rate taxpayer. Just put in as much as you can afford. And these calculations are deadly. But even if I say to you, that's exactly what you need to do. Are you going to do it? Great. Well, then that's exactly what you need to do. But max out as well. Try and get as much as you possibly can. The same advisor set up 2 Aviva policies, pension for me. One I pay into each month, and the other I top up, is a top up one, which I contribute to money when I have money. Okay, So this person has two pension policies, both with the same company. I mentioned the company, I shouldn't have. Both with the same companies. One they pay into it monthly, and the other one they throw lumps into it whenever they need to. However, when I went to do that last year, when I went to throw lump sum into it last year, he made me sign a letter saying he didn't advise me on this. And another fund may have been better. Whoa. I don't want multiple small funds as I think the costs are too much. Okay, he asked you to sign a letter to say that he didn't give you the advice and another fund would have been better. There should have been a thing called a statement of suitability with both of those policies. The statement of suitability is basically the advisor saying to you, this is why I'm advising that you do this. If there is no statement of suitability, I would ask him first. If there is none, I would be a bit concerned about that because it's compliance 101. It's one of the things that's required as a statement of suitability and has been for some time. Just on your other point, so you need to address that with him and ask him, where's my statement of suitability? And I wonder what fund he thinks you should be in. Yeah, there's absolutely, you know what I'm going to say here is there are absolutely brilliant advisors out there, but sometimes an advisor doesn't suit you. And sometimes you need to think about, is this relationship really working? And just because an advisor doesn't suit you doesn't mean they're not going to suit somebody else. In the most, and maybe I'm naive, but in the most, the people I engage with in my industry, the advisors, the financial planners, they're all trying to do their best, but sometimes the client fit, the fit between the advisor and client just doesn't work. If you're feeling uncomfortable about that, yeah, I would be just looking for your original statement of suitability. It's an interesting one, and I've no problem with there being two policies, by the way. You say I don't want multiple small funds as I think the costs are too much. Pensions are done on the basis, bar the pensions levy or the pension charge each year, they're done on a percentage basis. So if you're being charged 1.5% of €50,000, if you're being charged 1.5% of €100,000, it's the same as being charged 1.5% of €50,000 and €50,000. It's the same amount of money. So I don't really have a problem. As long as you don't lose track of them, I don't have a problem. And as long as you don't move address or anything in the meantime, you're still going to be able to find those pensions for years to come. So I don't have an issue whatsoever. Lots of companies will set these things up where they will say regular premium goes into this one, the monthly premium goes into this one, and single premiums go into this one. And it's just the way their IT systems work. The letter asking you about the fund being the wrong one, I'd be wonder about it. I have a rental property which will be mortgage free in 3 years. Hence, I do an annual tax return and make use of making pension contributions to reduce my tax bill. That's the end of that. Just clever. Great. Yeah. Perfect. I don't think that's a question. I hope it's not, because I don't get the question if it is. Investments and savings. Where's the best place to save? I've looked at state savings. I'm hugely risk adverse. Okay. I would like to save over the next 10 years for my children. So here we have a long-term goal, and they want to use a short-term vehicle because they're risk averse. I could put aside a sum now and leave it, or set up a contributory option. Please advise on what investment plans are on the market. I'm not going to talk about individual. Most of you know I won't talk about individual funds on the market or products on the market until someone pays me. But like this is classic mistake. People look at these things and they say, oh, I'm risk adverse, so what I'm going to do is I'm going to guarantee myself I'm going to lose money against inflation. Let's do the maths on this, right? If you have €10,000 today and you say, I'm going to put it away for 4 years, and 4 years is a funny thing, right? I'm going to put it away for 4 years. I'm using 4 years on purpose. I'm going to put it away for 4 years. There's a state savings, and I'm after mentioning it now, there's a state savings that pays you half of 1% per year. So in simple interest terms, that €10,000 is going to be worth €10,200 in 4 years' time. Now, inflation, which is the cost of your shopping, it's the cost of a basket of goods. How much you walked into the shop, if you buy something in the shops today, a basket of goods, you do your grocery shopping today, in a year's time, if it was €100 today, in a year's time, if the European Central Bank do their job and inflation does what it's supposed to do, that same basket of goods will be worth €102 in 1 year's time. It's 2%. That's what inflation is trying to be. That's what all the governments are trying to make it be, because that's good for the economy. More than that, and it gets scary. Less than that, and it gets scary. 2% is a good number. Now, in 1 year time, that €100 basket should be 102. Or something that costs €10,000 today in simple interest terms should cost €10,200 in a year's time. In 4 years from now, it'll cost €10,800. In other words, your state savings will have gone from 10,000 to 10,200, and your inflation, the cost of something that costs 10,000 today, will have gone to 10,800. You'll have lost €600 in simple interest terms over that 4 year period. Now, what you want to do is you want to multiply that 4-year period by 2.5 times. Makes no sense. And the reason why you're telling me you want to do that is because you're risk adverse. You're making life harder on yourself. If you go into a no-brainer 60-40 portfolio, there has never been a 7 or more year period where you would have lost money. Never. Not my 60-40 portfolio, a 60-40 portfolio. 60-40 portfolio is very simply put, it's where you put 60% of your money into the world stock markets and 40% of your money into government bonds and gilts. And corporate bonds and gilts. You give a loan of your money to companies and governments, or you buy a little bit of the companies or the company's shares. When you go looking for this, when you walk in to whoever you're buying it off, you don't go in and say, can I have Eoin McGee's 60-40 no-brainer portfolio thingy? You go in and say, can I put 60% of my money in the world stock market spread across the entire world? And can I put 40% of my money where I want to give it a loan to companies and to governments? Bonds, global bonds. That's all you're doing. 5 years, there is a 99.6% chance of a positive return on a 60-40 portfolio. Now, this is the interesting one. 1 year from now, if you put a lump sum in, 1 year from now, based on history, over any 12-month period, there's a 25% chance you will have lost money. The problem here is the biggest risk that this investment has of failing is not the investment being set up wrong or not doing what it's supposed to do or going up and down. It's the biggest risk to it failing is you. Because, for example, in a year, there's a 25% chance it's going to go down. So 1 in 4 years, it's going to go down. And you pull the plug when it does. You say, oh, I'm too scared of this. I'll go back to guaranteeing myself to lose money against inflation. Just be more clever. You're making life very hard on yourself. You are not risk adverse. Nobody has ever explained it. That's not your fault, but nobody's ever explained it to you properly. I'm not saying I have just now. I'm saying you need to sit down with somebody or read the book, How to Be Good with Money. And it's all in there too. Actually was looking at charts today. Still doing well. Thanks, everyone. But you really need to just get yourself, you can make a choice right now. You can either decide that I'm going to make life harder, I'm going to have to make myself make more money to put it into my savings because I'm getting a crap return, or I can educate myself and use the same money to get much more money back out of it, or use less money to get the same return. Your choice. Get yourself some education on it. It'll make a massive difference to you long term. I have learned as of this month, both my banks are now leaving the Irish market. I will have no bank when this happens. I have thought about the credit union and post office for my banking needs. Would that be a good option? Where is the best place to bank? I'm not going to tell you where to bank. I'm not going to make comment on the credit union or on post. But what I will say to you is that, yeah, it looks like 2 banks are leaving the Irish market. Well, Ulster Bank is. The KBC thing looks like it's going to go through. Well, sorry, we don't know if it's going to go through. They're into talks. I don't have any insight on that. So what I would say there is that when they leave, if they leave, all of the bank accounts will be sold in one go. They'll be moved over. One of the other banks will buy them up and you'll just move over and it'll be just business as usual. What I will say is it's actually quite easy to move your bank account from one bank to another. You walk into the new bank, you say, I want to move bank account, and they move it for you. They contact your old bank, they do everything. The only thing that you have to change yourself is if there's money being lodged into your account, like by your employer, your salary, you need to get down to them and say, here's my new bank details. But they give you this little templated letter that fill it out and you just give it to your employer and it's done. So it's very easy to move. Okay, that paused there for a second. It's very easy to move bank account from one to the other. So that's one thing. But what I would suggest is, don't know what's happening in the connection there, guys. Sorry. So what I would say is you can move it now if you want to. It's easy enough, or you can wait and move en masse, and you'll have another provider, and it'll probably be under the same terms and conditions. You generally advise against. Sorry, there's a question there that caught my eye. I wasn't going to answer these questions. Why do you say not to buy if only for 5 years if you sell at a profit? I'm saying don't put money into an investment that you have to have in the next 5 years, because there's a chance you might lose over 5 years. The chances diminish after 5 years. Ronan, you caught my eye there. I hope other people don't start thinking that I'm going to answer these. This is to answer the enough seminar questions, not the ones coming up here. You would generally advise against aggressively tackling, i.e. overpaying your mortgage payments. Is there any benefit to paying earlier to avoid interest over the term? So a couple of different things that go around about this. One is that if you pay every 2 weeks, you'll reduce your mortgage and you'll reduce the interest you pay in your mortgage. You absolutely will. Totally right. You know why? Because you make 13 payments a year instead of 12. There are 4.33 weeks in a month on the average month. So if you pay every second week, you will end up paying 13 4-week periods instead of 12 1-month periods. And so you make an extra payment each month, and of course that means the mortgage comes down quicker. If you can trick yourself into doing that, or maybe if you get paid every 2 weeks, it's not a bad idea to do it. I'm not mad on making overpayments on a mortgage. I think there's much better use for people's money than paying back the cheapest debt they're ever going to have. Anyone wants to look at it, have a look at my IGTV. Lockdown plan 14 and 15 goes into this in the lockdown plan. They sort it out that way. So, sorry, the lockdown plan 14 and 15, excuse me. So lockdown plan 14 and 15 will go through some of the maths on this, but I'm not a mad fan of overpaying the mortgage because there is emotional benefit to clearing down the mortgage early, but you only get the emotional benefit when it's gone. You don't really get a little bit of an emotional benefit once a month by paying a little bit extra. Nobody sits down and has a glass of wine in the evening and says, I'm delighted with myself, I paid a little bit extra off the mortgage. But people might open a bottle of champagne and say, the mortgage is gone today. So just get the big benefit at the end. I'd much prefer to see it bring the mortgage down on a monthly basis as it's supposed to come down and build a savings pot over here. And when you get to here and the savings is the same as the mortgage, make a decision then if it's important to you to do it and then clear one off the other. Big emotional benefit, but you have access to all this money in the meantime. Let's see if we can get a few more. How are we doing for time? We're going to do 2 more. I'm sorry, and guys, if you are one of the people who was on this and was hoping your question was going to be answered, as I said at the start, there were hundreds of questions. I'm not long out of college, so my questions are regarding pensions. As a young adult, what type of pension should I be going for? Savings. How much of my wage should I be putting towards wages for long-term future goals? House deposit investments. A brief overview of the best place to start with investing for your young adults. I'm going to just go for an absolute plug here and tell this young adult to read the book, How to Be Good with Money. Genuinely, because I think it'll be a book that will really help that person get their head around what they need to be doing. If you're just out of college and you're just starting your very first job, I want you to remember something. You have just got the biggest pay rise you're ever going to get in your life. I don't care what salary you're starting on. You are gone probably from zero or a very part-time job to a full-time job and a full-time wage for the first time. You have a massive opportunity to get your finances right. Simple terms, you want to know how much to save? You need to save 10% of your salary if you want to cover emergencies, 15% if you want to start to get ahead, and 20% plus of your take-home pay if you want to create real wealth. You are probably going from 20% of your salary at the moment up to 100% of your salary because you're going from a part-time job, or you're going from 0% to 100%. Challenge yourself big time there. Try and get as much of your money into savings. Think about it. If you were able to save, I don't know if you're living at home or what you're doing, but if you were able to save 50% of your salary, because you're not used to spending it yet. Parkinson's law hasn't kicked in, but if you were able to save 50%, after 2 months, you have a month's wages to one side. Like, that is an incredibly powerful position to be in. Rich people keep getting rich. You know why? Because it's cheaper to live in this world if you're rich. What do I mean by that? Let's take a simple example. Car tax. I was talking to somebody recently and they had car tax and they looked at it and they said, if I pay for this once for the year, it's like 198 quid. If I pay for this quarterly, the government are going to charge me 260 quid or something for the year. They're roughly what the figures are. Like, that's a ridiculous interest rate. And it's the government, it's a taxman who's charging you that. Why? For the benefit of paying it 4 times a year, or what I think it was 4 times a year, instead of just paying it once. That's why someone who can afford to pay their car tax in one go saves themselves in that circumstance 60 quid. Now, I'm doing that off the cuff, but the figures are around that. They save themselves 60 quid. They've got 60 quid extra to get a takeaway. The person who doesn't have the money ends up paying out the 260 quid, and probably because they're pissed off, end up getting a takeaway as well. So you have a massive opportunity. I know there are people who are listening, someone else caught my eye there, who can afford to save 50% of their wages. Nobody can, unless you're living at home and this is your first job. As I said at the start, this is your first job. You've just got a pay rise for the very first time. You've gone from earning 0 salary to earning a salary, and you haven't got used to spending any of your money. So thanks, Shenanigans. I hope that answers the question. I'm sorry, Shenanigans. I'm not trying to annoy people who can save 50% of their salary. But back to the point at hand. There are lots of people, including Shenanigans, who will say, look at your situation. Say you're just coming out of college. You're just starting work for the first time. and you have all your human capital ahead of you. You've got a massive opportunity, and I guarantee you there is a lot of people who would love to be able to rewind financially back to where you are right now. Don't mess it up. You have a great opportunity. Do read the book, and I hope it goes well. You have lots of opportunity ahead of you, as I said. I'm going to try and get one last one in. Should all life insurance cover be until end of life? Presently paying €160 per month for life cover for my husband and I until our youngest daughter is 22 years old. She's 6 at the moment. It's a one plan, includes critical illness. I have underlying health issues, hence the high premium. The need for life cover reduces as you get older. Life cover is really used to protect the income you haven't earned yet. And therefore, as you get closer to retirement and closer to not earning any more income, you have less to protect. So I'm not overly concerned. The underlying health issue would be my concern there, because if your circumstances change or anything happens, you may not be able to get the cover again if the health issues are a problem. So I'm going to call it at that. It is 9:30. I always try and finish these up in a half an hour period. I will be back on Thursday evening at 9 o'clock to do the usual Insta Live. And for those of you who weren't here at the very start, the news was out today that How to Be Good with Money Series 4 is back. I will have details later on in the week, probably early next week, about how you can apply for the show and how that works. And we'll be looking for people all over the country, all different types of people. There is at this stage, it's a blank slate. Nobody has got a place, and the type of people we're looking for, we won't know until people apply. So great news today, and next week I'll give you details, and I will see you on Thursday evening at 9 o'clock. Thank you. Good night.